Mortgage overview. So you're ready to buy a house, but you don't have enough cash to pay for it. Then you're going to need to get a mortgage. For those that do not know, a mortgage is a loan used to acquire a piece of real estate where the property is used as collateral until the loan is paid in full. As you will notice, a mortgage is comprised of two parts, principal and interest. You will also notice that at the beginning of a loan, the interest part is higher, and then as time goes on, the principal portion of the loan becomes higher. Your loan will have an amortization schedule breaking down the split of each payment, and I will show you what this looks like at the end of this video. Now, there are multiple kinds of mortgages, so let's go over the main ones. First, there are conventional loans, which are conforming and non-conforming. You then have jumbo loans, government-insured loans, fixed-rate mortgages, and adjustable rate mortgages. So let's cover these more in detail. First, conventional loans. These are going to be either conforming or non-conforming, so what exactly does that mean? Well, first, if you were to get a conforming loan, it means it conforms to the set of standards that are put in place by the Federal Housing Finance Agency, the FHFA, which includes credit, debt, and loan size. Now understand this, for 2022, for conforming loans, the limits were $647,200 in most areas and $970,800 in more expensive areas such as Los Angeles. These limits usually get updated yearly. And non-conforming loans are loans that do not meet FHFA standards. So let's explore the pros and cons of conventional loans. First, the pros. They can be used for a primary home, a secondary home, or an investment property. The overall borrowing costs tend to be lower than other types of mortgages, even if interest rates are slightly higher. You can ask your lender to cancel private mortgage insurance, PMI, once you've reached 20% equity. You can pay as little as 3% down on loans backed by Fannie Mae or Freddie Mac, and the sellers can contribute to closing costs. Now, the cons are you have to have a minimum FICO score of 620 or higher, generally. It requires a higher down payment than some other government loans. You must have a debt-to-income ratio of no more than 43% and 50% in some instances. You will likely need to pay PMI if your down payment is less than 20% of the sales price, and you will need significant documentation to verify income, assets, and down payment employment. Next up, a jumbo loan. These loans fall outside FHFA limits, as jumbo loans are more common in higher cost areas where home prices may well exceed the conforming loan limits. The pros of a jumbo loan are you can borrow more money to buy a more expensive house, and interest rates tend to be competitive with other conventional loans. However, a down payment of at least 10% to 20% is needed, a FICO score of 680 or higher is typically required, you cannot have a debt-to-income ratio above 45%, you must show you have significant assets in cash or savings accounts, which is generally 12 to 24 months of reserves, and it usually requires more in-depth documentation to qualify. Now, the third type of loan I want to go over is a government-insured loan. These can be FHA, USDA, or VA loans. First, FHA loans. They help make homeownership possible for borrowers without a large down payment or pristine credit. Borrowers only need a minimum FICO score of 580 to get an FHA maximum of a 96.5% financing with a 3.5% down payment. However, if you have a credit score of 500, it may be acceptable if you put at least 10% down. FHA loans require 2 mortgage insurance premiums, which can increase the overall cost of your mortgage. And lastly, with an FHA loan, the home seller is allowed to contribute to the closing costs. Next, USDA loans. These help moderate to low income borrowers buy homes in rural areas. You must purchase a home in a USDA eligible area and meet certain income limits to qualify. Also, some USDA loans do not require a down payment for eligible borrowers with low incomes. However, there are extra fees though, including an upfront fee of 1% of the loan amount, which can typically be financed with the loan and an annual fee. And last are VA loans. These provide flexible, low-interest mortgages for members of the U.S. military, which are active duty and veterans, along with their families. They do not require a down payment, mortgage insurance, or a minimum credit score, and closing costs are generally capped and may be paid by the seller. They do charge a funding fee though, a percentage of the loan amount which can be paid up front at closing or rolled into the cost of the loan along with other closing costs. So now that we know what each loan is comprised of, let's take a look at the pros and cons of government-insured loans overall. First, the pros. They can help you finance a home when you don't qualify for a conventional loan. The credit requirements are more relaxed, you don't need a large down payment, and they are available to repeat and first-time buyers. In addition, there is no mortgage insurance and no down payment required for VA loans. However, there are mandatory mortgage insurance premiums on FHA loans that cannot be canceled unless refinancing into a conventional mortgage. The loan limits on FHA loans are lower than conventional mortgages in most areas, limiting potential inventory to choose from. The borrower must live in the property. They could have higher overall borrowing costs and expect to provide more documentation depending on the loan type to prove eligibility. Next is fixed rate loans. These maintain the same interest rates over the life of your loan, which means your monthly mortgage payment always stays the same. And the most common types of terms are 15 years or 30 years. Now, the pros of a fixed rate mortgage are the monthly payment stays the same throughout the life of the loan, and it allows you to budget for other expenses more easily from month to month. As for the cons of fixed rate mortgages, you can end up paying more interest with a longer term loan, and the interest rates are typically higher than the rates on adjustable rate mortgages. And for the last main loan, we have adjustable rate mortgages, otherwise known as ARMs. These have fluctuating interest rates that can go up or down with market conditions. They have a fixed interest rate for a few years, such as 5, 7, or 10 years, before the loan changes to a variable interest rate for the remainder of the term. And if you consider an ARM, it's essential to read the fine print to know how much your rate can increase and how much you could wind up paying after the introductory fixed rate period expires. So, what are the pros of ARMs? Well, the main pro is that they have a lower fixed rate in the first few years of the loan, which can save you a substantial amount of money on interest payments and makes the monthly payment lower. In addition, the monthly payment and interest paid could go down if the interest rates are lower than what you have as a fixed rate when your variable rate period starts. However, the monthly mortgage payments could also become unaffordable, resulting in a loan default if interest rates increase above what you had your fixed rate at when the fixed rate term ends. And if home values fall, it could make it harder to refinance or sell before the loan resets and the variable interest rate kicks in. While those are some of the main types of mortgages, there are some other types of mortgages of home loans you may entertain, so I'll briefly mention those. First is a construction loan. These are needed if you want to build a custom home, which you'll need during the construction period. There are also interest-only mortgages. This is where the borrower only pays the interest on the loan for a set period of time. There may be a piggyback loan. This involves two loans, one for 80% of the home price and another for 10%, which is usually a HELOC, and then you have to put down 10%. And then there are balloon mortgages. These require a large payment at the end of the loan term in order to keep the monthly payment affordable. And finally, there's a bridge loan, which is where borrowers use their current home as collateral to buy another home. So now that you know about the types of loans, what is the mortgage company going to want from you when you apply for a loan? In order for them to do proper due diligence on you, you should be prepared to supply the mortgage company with at least the following: 2 to 3 years of previous personal tax returns and business ones too if you own a business, Form 4506, which you can get from the IRS at irs.gov, brokerage statements, retirement account statements, bank statements, tax return transcripts, which you have to request these from the IRS, financial statements if you own a business, and a copy of the future homeowner's policy. Believe me, this is just the tip of the iceberg regarding due diligence. Expect the lender to ask for more than this during the due diligence process. Also, request a due diligence list from the lender for what they're going to want to need as soon as possible so you can get a head start on it. Lenders are notorious for waiting until the last minute to get everything they need, and the last thing you want to do is be stressing out, trying to get everything to the lender so they can get everything approved before the closing date of the home purchase. Also know, if you're self-employed versus being a W-2 employee, The process that which you will go through is going to take longer and is going to be much more cumbersome. Expect the lender to scrutinize everything, as lenders believe that people that are self-employed are a lot riskier to lend to, even if you have plenty of assets and money. As I had previously mentioned in the FICO score video, it is highly important for you to have the highest score possible. Your FICO score is first going to determine if even you can qualify for a mortgage, and second, what interest rate you can secure. The higher your FICO score, the better chance you have of getting a mortgage, the type of mortgage you want, and the best interest rate available. Both the type of mortgage and interest rate you can qualify for is going to determine how much house you can afford, and for the long run, how much wealth you can create. Understand, for the majority of people, the greatest asset they have for creating wealth is their home. So it is imperative that you give yourself the best chance to eventually own a home at the lowest cost. Now, if the interest rate you qualify for is higher than you want, what can you do to lower it? Well, you can buy points. Points are upfront fees a buyer will pay for the lender to reduce the interest rate. Generally speaking, each point costs about 1% of the loan value, and each point will generally decrease the interest rate by 0.25%. But that can vary by lender, type of loan, and the lending environment. All right, now you finally have a loan, you're on top of your financial game, and you decide you want to pay your mortgage down faster. You can then make additional payments. However, you need to specify to the lender that the extra payment should be applied to the principal and not towards the interest. But before you do this, you should figure out if it is financially beneficial to make additional payments to pay down your mortgage or to take that money and invest it. Now, I know that was a lot about mortgages, but in addition to having a mortgage, you may need to escrow some expenses. So what exactly is an escrow account and what does it do? Well, an escrow is a legal arrangement in which a third party temporarily holds money or property until a particular condition has been met. Escrows will hold funds for real estate taxes and homeowners insurance in addition to good faith deposits that you make to buy a home. The escrow holder will make sure that your real estate taxes and insurances are paid. However, escrow accounts do not cover expenses related to home ownership such as HOA fees and utilities, so you need to pay those directly. Generally, the amount you need to escrow will be added to your mortgage payment, so it is in one total payment that you make each month. Now, while I hope you do not experience this, I think it's important to briefly cover the following topic. So, you've run into some financially hard times and you cannot make your mortgage payment. What happens? First, there is default, and then there is foreclosure. So what happens during these periods? Most lenders give you a grace period for payments to be made before the payment is considered late. For example, if your payment is due on the 1st, it won't be recorded late until after the 15th. After missing 3 payments, most borrowers will be considered to be in default and can then be foreclosed upon. This may differ by lender to know. However, most lenders will not foreclose upon until a borrower has usually missed 4 payments, but that is not a guarantee. If a borrower gets foreclosure notice, it means that the lender is taking control of the home. Now, if you get foreclosed upon, it will stay on your credit report for 7 years, reducing your credit score. This will negatively affect your ability to qualify for future loans with higher interest rates, so beware of the ramifications of missing payments and being foreclosed on. And lastly, before you sign on the dotted line, ask for a copy of the loan docs a few days in advance of closing, then read them and review all the documents to make sure they look correct. And by chance, if you have any questions, do not hesitate to ask. Look, this is more than likely going to be the biggest purchase of your life and the largest amount of debt you're going to take on. Therefore, you want to understand everything you're committing to. Just don't sign it because you believe it is a boilerplate item that everyone signs that buys a home. To get a better understanding of what an amortization table looks like and an understanding of the difference between a 15 and a 30-year mortgage, let's look at the following example. Most people take on a 30-year mortgage because it gives you the lowest monthly mortgage payment. However, some people choose a 15-year mortgage so they can own their home sooner and pay less in interest. Here's an example of a 30-year conventional mortgage versus a 15-year conventional mortgage and what an amortization table looks like. Now, as you can see between the 30-year and 15-year, that the interest rate differs. Obviously, the 30-year carries a higher interest rate than a 15-year because it's a longer life of the loan. Also, you will also notice that on the 30-year, you're going to pay substantially more interest on that 30-year than you are on that 15-year. And now if you want to look at the amortization schedules, you can see how the monthly interest and the monthly principal is broken down between the two types of loans. Now, as you can see, there's a lot to know about mortgages, especially if you've never gone through the process. Therefore, be prepared and educated about the mortgage you're applying for, and if you have any questions, do not hesitate to ask the broker or lender that is processing the loan.